In this week's video, we'll review the latest charts and data to help us answer the question: bottom, ongoing correction, or bear market? It's late on Friday evening. We'll be moving extremely quickly. Feel free to use the pause button on your video player. In last week's video, we said it was important to maintain realistic expectations about stocks falling further this week. And that's exactly what happened. Had an ugly week, but we did close on a positive note. The S&P 500 was up 117 points on Friday, but we still closed 102 points below the 200-day moving average. A week ago, we closed above all of these areas of potential support. On Monday, we blew through all of them to the downside. And while it would be an understatement to say the chart in front of us has a lot of work to do, it is noteworthy that on Thursday we closed basically on the 300-day moving average in blue, the same reference point that marked the low here in 2023. You can see for the most part the bear market in 2022 occurred below a downward sloping 300-day moving average in blue. Nothing magical about this level, but at a minimum it was nice to see a significant bounce on Friday. This is the ugly look of the S&P 500 as of Thursday's close this week, March 13th. A week ago on Friday, we tried to recapture the election gap here. We came extremely close, and that was encouraging. So a week ago, we closed above all of these areas of potential support, and then you can see on Monday, pretty much the polar opposite. We closed below all of them. So the look as of Thursday's close, we had 4 consecutive daily closes below all of these levels. That's the bad news. The encouraging news is, from this we got nothing type look on Thursday, Friday's session saw a strong rebound. And maybe more importantly, that rebound occurred on extremely favorable volume. We had a 90% up day, meaning 90% of the volume on the NYSE was associated with advancing issues. This is really the first significant feather in the bull's cap since the S&P 500 peaked here in February. Simply telling us to keep an open mind about the rally potentially continuing next week. At a minimum, it's a significant step in the right direction, helping us keep an open mind about a bottoming process. It's a weekly chart of the NASDAQ Composite as of the close on March 14th. We really have two markers for the current bull market. Back here in 2022, where the S&P 500 and NASDAQ bottomed, and this point here in October of 2023 that marked the end of this approximately 10% correction in the S&P 500. If we were to review this chart walking forward from this point here in 2023, you can see this week's close is discernibly different. It's the first time that we've had a weekly close on the NASDAQ Composite below the 30-week, 40-week, and 50-week moving averages. Nothing earth-shattering, but relevant. The last time that happened, January of 2022. That would be the bad news. The good news would be, thus far, numerous weekly momentum indicators, including the one shown on your screen, the True Strength Index, TSI, is well above the zero line as of Friday's close. That was not the case in January of 2022. So this would be your concerning look. This would be your not too bad yet look. We'll see how it unfolds. Similar concepts here. In 2023 and in 2024, weekly RSI never dropped below these blue horizontal lines. That was not the case at the close this week. It's a subtle shift in a weaker market, and since we're relatively early in this decline here, this is also a yellow flag. CCI down here all the way around negative 200. Sometimes that type of oversold reading on CCI can kick off a new long-term decline. You can see something similar happened in January of 2022. It's just too early to say one way or another, but we have to acknowledge that this is different, and this could be concerning relative to the duration of this decline. See, this one took several weeks over here, and eventually you become oversold. It's possible this one is a kickoff momentum drop similar to this area here. You may remember we showed this daily chart with the parallel trend lines. When we bounced on Friday, we really just came back to the lower trend line here. We need to see more to see if this is just a bounce or the start of something more meaningful. We're all human beings. We don't like uncertainty. These are probably the questions that we want to have answered. Are we in a correction? Are we in a bear market? And is the bottom in? Rather than trying to predict the future or remove uncertainty or focus on things that we can't control, we're probably better off focusing on these questions, things that we can control. How will I handle an ongoing correction? How will I handle a bear market? How will I handle a devastating bear market with a 50 to 90% decline? And it's easy when the market's falling to only ask one question. We need to be asking two questions. Question number one, why haven't you sold more? Well, that's just one side of the coin. Once you start selling, then you have to be able to answer the question, how am I going to get this money back into the market if the market bottoms soon, or if the market has already bottomed? It's also good to keep in mind, when you make a decision to sell, you have to make two decisions. When do I sell, and when do I get back in? If you make a decision to hold, you only have to make one decision. So ultimately, everything is a trade-off. We have to be thinking about all scenarios, and that requires us to think in probabilities. This is NASDAQ new highs, new lows. Thus far, this falls into the be open to. This is a correction rather than a bear market. 2025, thus far, looks similar to 2024, when a correction ended. 2023, near the end of a pullback, and 2023, near the end of the pullback, rather than January of 2022 in the early stages of the bear market. Having said that, if this look on the right side of your screen morphs into something more like this or this, we will learn something about increasing bearish probabilities. We now have a handful of daily closes on the NASDAQ 100 below the 200-day moving average. If you pause your video player, you can see that's a mixed bag. Sometimes it's not that big a deal. A short stay would be bullish. If we can recapture it, that could be favorable. If we can't, it tends to be concerning relative to additional downside. This version of the chart that we've been covering numerous times this year, broad growth stocks relative to broad value stocks, IWF relative to IWD. This is on the concerning end of the spectrum. We've had several daily closes in here this week that look different relative to the rearview mirror. And thus far, the bounce has stayed below this dotted line. It's easier to see if we zoom in on that area. This too would fall into the still has work to do category. If this ratio can get back out here, that would be a good sign. If you're a bull, you'd like to see a short stay below the dotted line. There's a different version of the same chart. These are AWOP lines. And this chart was dated March 7th and covered previously in a weekly video. So how does this chart look today? Have we violated these lines here? The answer is not yet. This chart has some concerning developments. This version tells us we should remain open to the trend remaining in place because we're still above the green line and we're still above the purple line, and that doesn't look discernibly different relative to anything that we've seen walking forward from May of 2023. That would be the good news. The bad news would be, after breaking out a second time above this level and this level, we'd obviously, from a bullish perspective, prefer that we didn't come back down below those levels. Similar concepts here. SPYG is in George relative to SPYV. This represents a band of strong potential support, and it also tells us to keep an open mind about the trend where growth outperforms value simply being in a counter-trend move. The analysis of this chart would change if we move into this area here. Both charts are dated March 14th. We often say in these videos that markets like to overshoot, and you can see small caps just did something that looks discernibly different relative to what we saw walking forward from the October 2023 low. Every pullback held above the blue line and the orange line. That was not the case this week. So if you're a stock market bull, you would like this to be a short stay. If we can get to this point here, that would be an excellent sign. So at this point, a mixed bag. This chart says we have to keep an open mind about the long-term leadership trend in tech remaining in place. We don't have a significant breakdown, and XLK outperformed VU slightly this week by 0.17%. Defensive staples relative to the S&P 500, the version of the chart that we covered last week. It's dated March 7th. XLP underperformed SPY for the full week by 1.81%. So we're kind of in no man's land here as well. If you're a bear, you obviously want to move in this direction here. If you're a bull, you would like this look here to end up being very, very similar to what happens next here. Different version of the same chart that we covered last week. This one dated March 7th. XLP divided by SPY. So where do we stand relative to the downward sloping orange line? Did we exceed it? And are we out here now on March 14th? The answer is no. Thus far, this chart too is telling us to keep an open mind, potentially about a low being in place, or that we've started some type of bottoming process. If you're a bear, you want to get out here. Chart that we covered a few weeks ago here, the smaller chart, XLI relative to XLK. We said it would be a bad sign if the ratio moved into this area here. If we look at the same chart as of the close on March 14th, that has not happened yet. Concerns would increase if this starts to look more like this, and this is calendar year 2022. NASDAQ relative to the S&P 500, the trend that began here, where the NASDAQ started to outperform again in late 2022, early 2023, is on the ropes, but we're holding above the purple lines. Similar situation here, March 14th. AIQ in the ETF world relative to SPY, telling us to keep an open mind about a bullish resolution, or at a minimum in the short run, tech reestablishing a leadership position. And that can happen in the short run with SPY falling and tech falling. But all things being equal, in terms of a bottoming process, if you're a bull, you'd like to see this ratio move in this direction. Similar situation here, XLK relative to VU. We covered this chart on March 7th. It's dated March 7th. How does it look today? We had an overshoot down here, but then we rebounded. So this chart, too, is in no man's land. There's nothing definitive here. There's no question we're more vulnerable to a breakdown today than we have at any time since this low back here in early 2023. Now, it's possible this is an overshoot here, but nonetheless, in the short run, that's a negative development. If you're a bull, you want to get out here. If you're a bear, you would love to see multiple closes below this dotted line. Here's another overshoot. We had a daily close below the orange line here, SMH in isolation, this is the anchored volume weighted average price line tied to this low back here in October of 2023. You can see that's the first time we've closed below the orange line. Again, if it's a short stay, that's bullish. So this chart too is in tweener land at the moment. In the final segment of the video, we're going to examine these questions here, but we're going to do so by thinking in probabilities. It's a tweet from Tuesday. You can find it in our X feed. Here's the handle. Here's where price was here. If we fast forward to Friday from a negative perspective, we lost these lines here. And more importantly, we lost the July high here. We lost this point here. That would be on the negative side of the ledger. The positive side of the ledger, so far we're trying to make a stand similar to an area where we made a stand in August of 2024 and April of 2024 near the red line here. This is the S&P 500. These are anchored volume weighted average price lines, areas of possible support. Now, this is where we want to think in probabilities. This is SPY, the S&P 500 ETF in isolation. It's important that we understand the concepts on this chart because every chart that follows is going to use these concepts and these dates. Anchored volume weighted average price lines. Typically, when you go to a major high, this is the peak here on January 3rd, 2022. We're anchored to that point. This is the low here for SPY in October of 2022. The orange line is anchored to that point. Similar concepts here. We're anchored to this intermediate term high in July of 2023 and the low in October of 2023. Purpose of the exercise. As long as SPY remains above this blue line and this red line, for the most part, this uptrend off the October 2023 low is intact. The same can be said for this orange line and this blue line relative to the rally off the October 2022 low. So right now, from a probability perspective, if we looked at this chart here in the context of these questions, right now we would have to classify this as a correction within the context of an uptrend that started in October of 2023. Now, having said that, how do other positions look if we use these exact same dates to anchored volume weighted average price lines? For example, these are the exact same anchored dates, but they're applied to the NASDAQ composite in isolation. So right now, the NASDAQ looks like it's trying to make a stand after a short overshoot here at a similar point relative to August of 2024, April of 2024, and October of 2023. So this uptrend seems to be on the ropes, but as of this recording, still in place. Now, having said all of that, if we go back to the SPY chart, it can help us plan. It's possible that SPY is going to backtrack to this red line, this blue line, this orange line, or the darker blue line. And all of that could happen within the context of the existing uptrends. These two lines tied to the uptrend that started in October of 2023, and the other lines tied to the uptrend that started in October of 2022. Notice they're all upward sloping. And from a contingency planning perspective, it's helpful to know if that did happen, how much further would we fall, and what would the total drawdown be? First, let's start here. The maximum drawdown that we've had in the S&P 500 thus far was Thursday's close at 10.13%. And that is basically a typical correction. It lands right in the middle of those corrections going back to 1950, the maximum annual drawdown. This table down here tells us that if we drop down to this red line, this is at 522.91. 522.91. If, hypothetically, SPY backtracked to this level here, this upward sloping red line, the total drawdown from this peak here would be 14.69%, and the incremental drawdown from Friday's close would be 7%. So we want to know, how would we handle that? If we go down to this line, the total drawdown hypothetically would be 17.78%, and it would represent an additional 10.46% drawdown from Friday's close. If we go to the orange line down here, tied to the October 2022 low, that would be a total drawdown of 24.97% and an incremental drawdown of 18.29%. And if we go to this line, tied to this January 3rd peak 2022, you can see the market thought both of those lines were important here when we held at the intersection of orange and blue. If we come all the way back here to the lowest line, hypothetically, that would be a total drawdown from peak to trough on a closing basis of 28%. The incremental drawdown from Friday's close would be 21.63%. This data helps us with our contingency planning, and it helps us answer these questions. So now let's look at numerous ETFs and indexes using these exact same anchor points. Every single chart is going to use the peak for SPY here, the bottom for SPY, the peak for SPY here, and the bottom for SPY here. Why? Because most of these ETFs are correlated. They all have a tendency to bottom in close proximity, and they all have a tendency to peak in close proximity. And thus, looking at multiple charts helps us with the weight of the evidence. So far, the Dow, as of March 14th, it looks like a normal pullback within the context of the trend that started in October of 2023. Same can be said for the NASDAQ 100. It held here, we're back to a similar area. ARK FinTech Innovation above all of the SPY lines here. However, if we anchor a line to the peak for ARKF here in 2021, we're starting to test that line in a somewhat concerning manner. You can see we had a daily close below here and a daily close below here. So this too is a tweener chart. IGV software trying to make a stand near a logical area. Home builders. Here's a breakdown. This looks discernibly different here relative to everything that we saw walking forward from this low in October of 2023. Similar situation for small caps. This and this looks different from all of this. Remember, short stays are not uncommon, so if we pop right back above, that actually could end up being bullish. If these levels don't hold, these levels become the next set of reference points for IWM small caps. The bigger problem with small caps is the continued poor relative performance. IYW Tech trying to make a stand near a logical area. The NASDAQ 100 ETF 1Q still above the upward sloping red line. And again, all of these dates come from SPY. You can see 1Q peaked before SPY. It peaked in 2021. SPY didn't peak until early 2022. How about the triple Qs? Still above the upward sloping red line. And even if this trend remained in place, it opens the door for additional downside. RSP, nothing particularly alarming relative to the look walking forward from the October 2023 low, the current trend. There's no question price action in here for SCHG as in George looks a little bit more vulnerable than this look here and this look here, but so far we're above both of these lines. Not making any assumption about whether or not any of these lines will hold. They just help us assess probabilities and answer the questions in a probabilistic manner. Your semis with a few days of overshoot here, this looks different from anything that we've seen walking forward from that October 2023 low, but it also has somewhat of a short stay look. So that's a tweener chart. We'll see what happens next. Tech VGT, also in tweener land. VUG still above an upward sloping red line here, tied to the October 2022 low. Nothing particularly alarming about the longer term trend with XLC, Communication Services. Same can be said for XLI, Industrials. Tech XLK, vulnerable, but still within striking distance of the red line and still above the upward sloping blue line here. Similar concepts to what we already covered. This is XLP relative to SPY using the anchor dates for SPY that we've been using on all of these charts. This is the day the S&P 500 peaked before the bear market in 2022. This is the day the S&P 500 bottomed in October of 2022. This is the day the S&P 500 peaked in July of 2023. And this is the day that the S&P 500 bottomed in October of 2023. And you can see thus far, this looks similar to this point here. If you're a stock market bear, you want to get out into this area here. Like many growth-based ETFs, tech and growth, XLY's been hit hard. That's the bad news. The good news is it's still above the anchored line that's tied to that October 2023 low. So if you're a client using the data on your screen here that we covered earlier, our job continues to be that we want to balance the desire to stay invested with the long-term uptrends, with the realization and understanding that from time to time, markets experience significant declines on the order of magnitude of 50 to 90%. We know how we're going to handle these situations, and we know how we're going to answer these questions. That doesn't mean any of this is easy. All of these decisions represent trade-offs. What do I mean by that? If we knew with 100% certainty that we just experienced a 10% correction and that we were going to go on to print a higher high and the correction was over, then in terms of our long-term performance, we'd be better off doing absolutely positively nothing. Typically, when you take incremental defensive action, it's going to harm performance. That's why you have to be able to answer both questions. It just can't be about selling when screens are red. We have to think about our long-term goals. Our daily actions have to align with our long-term goals. And we have to balance all of that with the strong desire to avoid an outcome like this. Hence, trade-offs. As of Friday's close, we're exactly where we should be in terms of balancing both ends of the spectrum. The secular trend continues. We're going to go on and print a higher high eventually, or the secular trend thesis is taking on water, and we're going to end up with this type of situation. So when we look at Friday's session for SPY, what once acted as support in here may now act as resistance. For the stock market bulls, it would be an outstanding step if SPY could recapture the election gap here. It would also be a good step if it could recapture the 200-day moving average here. Also noteworthy from a contingency planning perspective, our maximum drawdown was Thursday of this week. For the S&P 500, on a closing basis, it was 10.13%. If we look at the historical cases that made it to 10.13%, the average and median drawdown for the historical cases inside the orange boxes, 14.6% and 14.4%. Telling us, even if we avoid a bear market, it's within the realm of possibility that our 10% correction could morph into something more like a 15% correction. It's also quite possible that, like many of these historical corrections, that you get down around the 10% drawdown correction area, and that's it. I think it's also noteworthy that these 14.6 and 14.4 numbers here align nicely with this reference point that we have right here in the form of this red line. Hypothetically, if SPY came back to this red line, which is anchored to the October 2023 low, the total peak to trough drawdown on a closing basis would be approximately 14.69%. And it's also noteworthy. Every single one of these cases inside the orange boxes, after the low was in, the market went on and printed a higher high. Our scores bounced a little bit on Friday, but they've understandably taken a hit. And our allocations as of Friday's close are in line with the numbers on your screen. And everything that we've said in this week's video has to be taken in the context of the topics that we covered in last week's video. And we all know the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.